This is Bloomberg Intelligence.
We're really getting into now the streaming's arms race.
Dish is looking at that and saying we can really build a nice niche for ourselves.
In-depth research and data on 2,000 companies and 130 industries.
The dollar is the dominant concept in the planet.
I think the acquisition is a natural progression of what Microsoft can do with this technology going forward.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Over the next hour, we are going to dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
Happy New Year, Paul.
Happy New Year to you as well.
Happy New Year to all our listeners, too. Today, we're going to explore the life science sector and what's expected in 2023.
Plus, what's in store for retail now that the holidays are over?
But first, you got recession fears are going to linger for global bank stocks. You got concerns about inflation, rising credit provisions, and only some economic weakness is yet factored into estimates. And we get earnings coming out in just about a few days. So Bloomberg Intelligence Senior Banks Analyst Alison Williams joins us now. Okay, Alison, what are going to be the key numbers that you're watching for when these big guys report?
The key number continues to be loss provisions, just in terms of framing how the banks are thinking about the year ahead. I think the key leading indicator, we think in general for the capital markets business, first quarter tends to be the strongest, and so fourth quarter we know is pretty weak. It's not going to be that meaningful. The questions in terms of revenue are going to center around, how the first quarter's going. Granted, we're very early in the year. Is there potential to execute some of the banking fee pipelines? That was a big disappointment last year. And then what are we seeing in terms of loan growth? What are we seeing in terms of net interest income? That was a huge story last year. We expect some slowing in terms of the growth rate for net interest income, but we'll be watching, again, for loan growth. Card, it tends to be a seasonally strong quarter, and we'll see if consumers were using their cards over the holidays.
Yeah, you mentioned loan growth there. I know that some of and it's not just, in the mortgage market or the consumer market, but I remember Jamie Dimon saying over many quarters and the Bank of America folks saying the same thing, that loan growth and loan demand really wasn't there over the last several quarters, and maybe that was simply a function of the government was loaning so many people so much money with all the stimulus. How do you expect that to look in 2023?
So loan growth throughout really the pandemic was disappointing, and it is exactly as you said, attributed to the stimulus. And credit card, which is one of the most profitable or the most profitable loan product for these banks, was really the hardest hit. And so what the banks are looking for as we move into 2023 is for those loans to normalize. We did definitely see some improvement, especially on the commercial side of things last year. We saw in the third quarter, we actually saw some pullback, but that was strategic in terms of the banks keeping control of their balance sheet just so that they could make sure that their capital ratios were shored up in accordance with some higher requirements. So we saw a little bit of pullback in commercials. That should steady, we think, this quarter. Again, going back to credit as being, I think, the big wild card for this year.
Totally. And whether you're dealing with credit for a consumer or you're looking at it from companies that they're lending to, what do you think we're going to hear about recession and default risk, whether or not you're dealing with a consumer or other companies?
I think we'll still hear that things are pretty healthy. Keep in mind that the worries are all forward-looking, and even though recession fears really weighed on the stocks last year, it was a very strong year for credit. We do expect to see reserve building. Again, we talked about some of the growth. When loans grow, you have to increase reserves. But I think that investors will be keying on, what are the changes to some macroeconomic assumptions. We already know that J.P. Morgan is going to increase their reserves perhaps a little bit more than had been expected a couple of months ago due to both the growth and a little bit of a change in the assumptions. But again, I think that the biggest takeaway for investors, or what investors should focus on, is the fact that these banks are extremely well positioned to take on any increase in provisions. The last two cycles we had were crises. We had the pandemic, we had the global financial crisis. We think that this is going to be a much more manageable sort of plain vanilla recession, if you will, perhaps closer to the 2000s.
Hey, real quick, Alison, do I even bother? If I want to get exposure to the investment banking business, do I even bother with the European banks, or do I just stick with the U.S. investment banks?
So this will be an interesting year, although we've said this perhaps for the last several years, right? Because for the U.S. banks, really the advantage has been this virtuous cycle since the global financial crisis. So they sort of got their problems behind them earlier. The economy, they had the benefit of a healthier economy, so that helped the revenue, which allowed them to invest more. And technology, as you know, has been sort of the key battleground for these companies. So they've been able to invest in technology, and they've been reaping the rewards of those investments. And so it's been sort of a virtuous cycle. In Europe, I think what's interesting is you do finally have now some lift in rates, so you could get some help. Obviously, there's still some economic concerns there. And so, we'll see what lies ahead. We've had some other European competitors getting a bit stronger. So we think that the competitive landscape for the global investment banks will continue to be interesting.
Very diplomatic way of talking about Credit Suisse, I got to say. All right, Alison, thanks a lot. Bloomberg Intelligence Senior Banks Analyst Alison Williams.
All right, let's turn now to the fintech space, as names like Visa and Mastercard are expected to lead their peers this year thanks to revenue resilience and strong balance sheets. Bloomberg Intelligence Senior Financial Analyst Diksha Gera joins us now to discuss. So, Diksha, when I think about fintech, it's obviously, as the name implies, a confluence of financial services and technology. It's a relatively new part of the financial services space, at least for me. How should investors view this space? Should we focus on the big names like a Visa, like a MasterCard, or maybe look for the more technology-driven names?
Yeah, so Paul, this is like a mix of a lot of names which fall under both categories, as you can see. And what we try to focus on is also specifically within the payment space, because a lot of those names are leading the bandwagon in terms of, taking those advancements in technology and executing some of that new tech. So the way we look at it is the card networks, the merchant processors, and then the newer fintech firms like Marqeta, like Toast, who are kind of leading the charge on integrating technology and financials.
What happens if the U.S. goes into recession and consumers get crunched? Where in the fintech payment world will we see the pain the most?
If you just look at the fintech and payment stocks that we've tracked in the last 18 months, they have seen a significantly sharper correction versus the S&P 500 index. They've underperformed the index by almost 40 percentage points. And a lot of this, I think, already can be attributed to easing growth expectations, because what happened is that there was a surge in digital payments and finance, which was pulled forward into 2021. And this was despite reasonably healthy earnings all the way up until the September quarter. And there are concerns that growth is going to fade this year and there's going to be more competition. We've seen fantastic volumes come through to these merchant processors and card networks and even the newer fintechs in that aspect. So there is near-term caution on consumer spending, and particularly because of inflation, because of rates where they are, and also because of supply constraints. And that has been exacerbated by revived concerns around the legacy versus the modern processors, who's going to disrupt who, and also due to additional regulation that's kind of lingering around.
Diksha, I'm probably like a lot of other consumers that my usage of financial technology skyrocketed during the pandemic. So now on my phone, I've actually got the little window that's got 4 or 5, I take that back, 9 apps for financial services there.
You have 9 apps on your phone for that?
Just for that.
Very impressive.
It's pretty interesting. So, Diksha, what's the new cool thing that you think the financial services industry is really focusing on now in terms of fintech?
I think that's a very interesting point, Paul. So I moved from Asia 2 years ago, and I was very surprised at the pace at which things were happening in the U.S. And I think part of it is because of the regulatory environment being very different between the Western and the emerging countries. So payments using a mobile phone was like everyday business, right? There's nothing special about that in Asia. Whereas here, if you see, it is still... it's work in progress, right? You can't just go about and not take out your physical card to make payments in the U.S. everywhere. So we've not seen QR code-based payments. We are yet to see integration of a lot of these apps to become omni-channel, right? You can't just pick out your app and pay at any shop and every shop that you want. So I think what is going to happen is a lot of clearing up of that domain and build up of that ability for an omni-channel environment. And then we're going to see a little bit of consolidation as well with regards to not just from a user standpoint, but also from a company standpoint. I think 2023 could be a litmus test for these super app contenders, as we can call them. Investors are starting to focus on cash. These companies have been throwing money to gain user base and grow engagement. But I think 2023 could be a full pivot from just focusing on user growth to more retention and to increasing engagement and to getting them to use one app for everything.
All right, Diksha, thanks a lot. We really appreciate Diksha Gera, a senior financial analyst for Bloomberg Intelligence. Thank you so very much. I gotta say, I don't carry cash at all.
Oh, you're killing me.
I don't even have a penny.
You're like my kid. I mean, it's just unbelievable. All right, coming up on the program, we take a look at the life sciences sector and how it can maintain its resilience in the coming months.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence through BI Go on the terminal. I'm Alex Steele.
And I'm Paul Sweeney, and this is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, the backdrop for the life science tools industry is operationally sound as we begin the new year with robust demand across all major regions. For more on the space, we're joined now by Bloomberg Intelligence senior healthcare analyst Jonathan Palmer. Life sciences, give us a sense, Jonathan, of the types of companies you follow, kind of where they fit in the greater healthcare scheme. And I use that word, I don't know how I use that, but in the healthcare area, and give us a sense of some of the companies.
Yeah, I think that's a great question, Paul, to set it up for context, because life science technology companies are not ones that come to the tip of people's tongue when they think of healthcare. But these are the manufacturers of the picks and shovels of the global research and development engine. And these are companies like Thermo Fisher and Danaher and Agilent and PerkinElmer. And they make a lot of the tools and products for drug discovery, for manufacturing, for production. And really, they're very scientifically focused, the instruments and technologies that they use. But a lot of what's been happening the last couple of years is these companies have had a huge boon from COVID and the pandemic because they make the tests that, we've been using for the last couple of years, and they make all the equipment for vaccine production, drug production. So they've seen a huge spike in demand for some of their products over the last couple of years, which has been extremely profitable for them, and they've reinvested that back into their businesses. And as we look ahead to 2023, that biopharma customer base, the big Mercks and Pfizers and Roches of the world, they're all doing pretty well, and demand for R&D is pretty strong. The one area that we're watching as we kind of transition into this new year is China. China's been a big customer for these companies. They're about 15-20% of revenue. And what happens there vis-a-vis the pandemic and potential lockdowns could maybe be the only monkey wrench in what's otherwise a pretty strong story.
But if they got such a boost from COVID on a comp level, aren't their profitability and sales just going to be lower as people test less, as the big testing centers kind of trail off?
No, that's true. I mean, the numbers have actually come down even from 2021, which was the peak. And so they were a little lower last year. And we're kind of reaching this endemic state as we head into the new year. That's been pretty well telegraphed and kind of reflected in valuations at this point. It's a pretty well understood phenomena that, there was this huge influx of money, into their coffers, and that they wouldn't be able to maintain that profitability once the pandemic ended. But the good news for them is these are all pretty strong companies from a balance sheet perspective. They grow both organically, but also by doing a lot of deals. And so that COVID money helped fuel a ton of acquisitions over the last couple of years.
How have the stocks performed over the last several years? Presumably pretty well with that pandemic play.
Very well.
Yep. So is the expectation, is there more room to go in these types of stocks? Like, we're heading into the most widely telegraphed recession of all time. Historically, think of healthcare as a safe haven, if you will. Is that still the case? And does your subsector here of the equipment manufacturers, does that play?
No, that's a great question because these guys are somewhat insulated and are a very defensive group within healthcare, which broadly speaking is defensive. People still get sick. They still have to go to the doctor, whether there's a recession or not. But for the life science technology companies, their customers are those Pfizers and Mercks of the world. They invest for the long term. It takes 10 years or more to bring a drug to market. So just because there's a recession, they don't necessarily turn off the spigot in their investments. So as we sit here today, and think back to the last big recession we had in 2008, I mean, these are not high growth companies like maybe tech was the last couple of years. They're kind of mid to high single digit growers. When we had the great financial recession of 2008, 2009, the worst case scenario for a couple of these companies, was they saw revenue growth decline by a couple percentage points, but they were able to maintain profitability. So it is very much a safe haven within the world of healthcare.
However, a lot of private equity people that I talk to, like the first thing out of their mouth is life sciences. And I understand you're dealing with public companies, but is there a lot of enthusiasm, and has there been already in the sector? So if you do have fraud that comes out, does this make this a little vulnerable this time around? Yeah, that's another good point. I mean, we've been in a, kind of once in a lifetime funding environment by the biopharma industry from venture capital and private equity. That's been going on for the last decade plus. I think we're kind of in a different market. The public equity markets aren't very kind right now to people wanting to come public, to say the least. There hasn't been any real biotech IPOs. That said, that 10-year horizon to get a drug to market doesn't stop just because the public equity window is closed. So there's still going to be financing into those companies. There'll probably be a lot of consolidation in the biopharma space for the smaller biotechs. But at the end of the day, really the large and medium-sized companies in the biopharma world are what funds this group, or are the derivative customer of this group. And they're the engine of growth, and they're not going to be, looking for capital anytime soon. Going back to China, does China want our technology, or do they want to develop their own and keep us out? And I think of some of these life science companies. Yeah, there's a couple good examples of that in this space. And I think, there's the kind of rudimentary scientific technology or very high-end innovative technology. Chinese customers buy that. There's drug labs from Pfizer and Roche in China. There has not been a Chinese superstar to emerge, a local company to emerge in this space. The one that maybe comes to mind is in the world of gene sequencing, where they actually do have a national champion who competes with the big gene sequencing company Illumina, who's based out of California here and has been kind of the 900-pound gorilla in gene sequencing for the last decade. But for the most part, the U.S. and Europe has been a couple steps ahead in terms of China, in terms of their innovation, particularly in this space. And there's only maybe a few examples where China's caught up, but they're few and far between. They need to import Western technology. Exactly. They do. And then within that market, the Chinese market, a lot of these companies have made in China for China. So they're almost scaled down versions of their higher technology products that maybe Chinese customers who are a little more price sensitive or don't necessarily need as high sophistication buy a more scaled down version of some of this equipment. Can you walk us through some of the really interesting things that are going to be coming out of these life science guys over the next decade? I know it's farther out looking, but this is where a lot of the innovation comes from. So we've seen a couple big trends over the last couple of years, and I don't think these would be a surprise to anybody. COVID and investment in vaccines and infrastructure and new types of technology to treat diseases. We had the mRNA vaccines. That's relatively new. We've seen a lot of investment in gene editing and viral vectors, these newer technologies that are hopefully going to be coming into the clinic and can treat diseases. And so the life science technology companies who make all the equipment to, make these discoveries and then manufacture the drugs that come out of it will be kind of the beneficiaries of a lot of this investment. So gene therapy, like I have an illness that's specifically to me, and then I'm able to get a drug tailored to me. Is that what that in essence means? Yep. Exactly. It feels totally game-changing. I know, it does. And it's not just, this mRNA technology that we benefited so much with the vaccine for the pandemic. Now we're finding other uses for cancers, for example. There's cancer vaccines that Moderna and Pfizer are working on. What are some of the companies that are in the strongest position right now in terms of their product pipeline in the medium term? Yeah, so there's two or three that come to mind. The two biggest are Thermo Fisher and Danaher, and they've been the industry consolidators for the last decade. They kind of sit in the upper echelon in terms of breadth of products, breadth of services, global reach. They're always buying other companies to kind of add to their toolkit. They are probably the first that come to mind. A smaller version of that is a company called Perkin-Elmer, which is more of like a mid-cap or it's a large cap, but not quite as large. Yep. Thermo and Danaher are in the hundreds of billions. Perkin-Elmer is very similar. It's a smaller version, and they've been actually acquiring some interesting higher growth assets and also selling some of their businesses that are more, let's call them industrial focused and slower growing to really focus on these niche high growth areas of healthcare.
Good stuff. As always, Jonathan Palmer, pretty smart. I wonder who hired him, actually. Jonathan Palmer.
That was Paul.
Bloomberg Intelligence Senior Healthcare Analyst. Thanks so much for joining us.
All right, coming up on the program, we're going to discuss what's ahead for retail now that the holidays are over. Plus, we'll explore why a campaign spending rebound looks set to fade in 2023 as advertisers' budgets are now threatened.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies in 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alex Steele. It's 25 minutes past the hour, and this is Bloomberg.
You're listening to Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
We'll be here each and every week at this time tapping into our Bloomberg Intelligence analysts covering some 2,000 companies in 130 industries worldwide.
So margins. That's going to be the word for 2023. Margins and profitability. So what does it mean in some of the retail staple guys like a Walmart and a Kroger? They got higher cost for labor, higher cost for products, and are they going to lose some consumer spending power as a recession maybe takes hold? So let's bring in more with Jen Bartashus, Senior Packaged Food and Retail Staples Analyst. Hey, Jen, what is your big, broad case for this year?
Well, when we look at it this year, we do see just margin pressure galore, as you alluded to. We are seeing, still a strong customer, but we do think that inflation should hopefully start to ease a little bit in the second half of the year. We're starting to see some prices come down a little bit, and so we're a little bit hopeful that things will become a little bit more manageable for consumers as the year progresses.
I mean, there's so many things to talk about from an inflationary standpoint, Jen. Let's talk about labor, because I know for the retailers, that's something there as it is for many business sectors. How does retail deal with that wage inflation?
Well, with retail, it's a little bit unique because they have so much of their workforce that is on an hourly basis. And so they have a lot of ways that they can try to help control labor inflation. And part of that is by investing in tools that will help make the associates they have more efficient. So we'll see a lot of that kind of CapEx spending towards technology and tools for employees. But they also have the flexibility to cut hours, or to not bring people on full time. And so we may see a resurgence of more part-time employment versus full-time employment, which had been a trend going into the last couple of years.
So I'm an investor and I'm looking at it. Is it going to be cost control that's going to be more important to me than maintaining that margin? Is it going to be top line growth? Like if I'm only going to spend $10 and I spend it at Walmart versus Dollar General, does that matter more to the investor? What am I going to care about the most?
I think this year, the thing that people are going to be really caring about is margin, and it's about cost control. The top line has been very healthy because it's been helped by all the inflation. So especially in retail staples where people are buying food, they have to eat. And so what they spend that $10 on might change, but they're still going to keep spending money to be able to put food on the table. It's a question of how profitable you can make that purchase. And so for us, margins are really what's going to be in focus. And it's about where these retailers can control costs and where they can, use dynamic pricing so that they can pass through costs where they can, but also hold prices in other areas so that they can preserve their value perception with their customers to maintain loyalty.
Hey, Jen, talk to us about kind of where the grocery business is in terms of e-commerce, because it just seems food doesn't come top of mind that's where you would use e-commerce. Kind of where are we in that?
Well, we're sort of in a catch-up area with regards to e-commerce, and that's because during the pandemic, obviously, it spiked. Lots of people tried online grocery for the first time. The growth rate has really fallen off and has really slowed, but the actual amount of business that's still transacted online is very high and still very steady. And so what we found is that online shopping behavior is sticky. We're not getting a lot of additional growth out of it at the moment. It's still very low single digits growth now, but it is still growing, and it is something where we see that omni-channel customers, so if you're shopping online and you're shopping in stores, tend to spend 3 times as much at the same retailer as if you do only one or the other. So there's a big incentive for those retailers to make sure that they're serving customers both online and in stores to really lock in that spending budget.
That feels like that's more of a buy online, pick up in store scenario. Like, is that the holy grail here?
It's partly that, but it's also that, there's a whole rise of smart data usage by these companies. And so, you're getting digital coupons now that are kind of tailored to you and to your shopping habits. You no longer have to look through a newspaper flyer or go to the store and look at what the sale stickers are on the shelves. You're getting deals served up to you. And so if you're engaging digitally, you benefit from that. And then when you're in store, you benefit from things that you see on the shelves. And that together makes you a much more loyal customer and a much more profitable customer for those retailers.
Hey, Jen, where are we in terms of the supply chain story? That was such a big story in 2021 and a good part of 2022. Is it pretty much in the rearview mirror, or is it something they're still dealing with?
Well, I think that the worst of it is over, but there are still lingering issues, and it's because it bleeds through the entire process. And so if there are delays in getting ingredients to food manufacturers, then there are delays in them being able to produce the food and have full orders that go to retailers. So we're still seeing spotty gaps on shelves in retailers. It's much better than it was, but until we get it flowing, everything flowing through from that ingredient all the way through manufacturing and then out to the retail, we're still going to see some delays and some hang-ups. So we're expecting that there's still to be some overhang in terms of that type of delay throughout this year, but it will continually get better. Right now, when you talk about how much of an order a retailer places that actually gets filled, we're still not back in the 90% for most companies. And so that's going to be a metric that a lot of these companies will be looking at this year and trying to making sure that they're getting everything they're ordering so that it gets on the shelves and it's there for consumers.
Interesting. Which retailer is handling all of this best?
Well, I think the thing that's interesting about this space is that it really comes down to scale. And so different companies
she's 2
have
seconds away from
strategies.
saying Walmart. Watch for it.
Different stores have different strategies. Obviously, the size of Walmart is a competitive advantage. The size of Amazon can be a competitive advantage. But what's very interesting is that it's a very fractured sector when you think about where people buy food. And if you look at the top 10 companies that sell food, the only company that's a pure grocery store in that top 10 is Kroger. The rest are things like Walmart, Costco, Walgreens, CVS, Target. 7-Eleven is even in the top 15.
Really?
So it just goes to show you how diverse it is in terms of where people buy food and how fractured that market is. So that's where scale really becomes an advantage to be able to lower costs and operate efficiently to be able to serve customers best.
Good stuff, as always. Jen Bartashus, she's Bloomberg's Intelligence Senior Packaged Food and Retail Staples Analyst, bringing us the latest. All right, let's turn to advertising. As a campaign spending rebound is set to fade this year, thanks to mounting economic headwinds. For more, let's welcome Bloomberg Intelligence Senior Media, Advertising, and Telecom Analyst Matthew Bloxham. So, Matthew, kind of looking out at the ad spend here, we got a looming recession. It's an odd year, which means there aren't any real big elections in the United States. Where do you guys start from in thinking about the global ad pie?
Yeah, well, it's a $700 or $800 billion market, so it's a huge bit of business. And I think historically it's been very tied to the economic cycle. And I think in terms of actual spending by advertisers on media, I think that's still going to be very much the case. But when you look at the kind of the businesses that are at the center of this industry, the big global advertising agencies, they're not really just about creative advertising anymore. That's still a big part of their business, but many of them over the last 4 or 5 years have spent billions of dollars on M&A to diversify into more technology-led business. As you can imagine, most advertising now is done through digital platforms like Facebook and Google, and that needs a lot more technology both to deliver the ads and to monitor their effectiveness. And so there's been a big ask from the advertisers for people to help them with that technology transition. Now, historically, that business has gone to people like Accenture, Deloitte, the big IT consulting firms, but there's been an opportunity there for the agencies to get involved, and Interpublic and Publicis in particular have spent big on that, and it's delivered for them in terms of revenue growth. So I think that's going to be an important factor over the next 12 months, is not so much the ad spending, which unquestionably is going to slow in terms of growth, but it's whether these big agencies can make up for it with this technology diversification.
So are there certain areas where things are holding up better? Like, I don't know, are there countries where things are okay, where they can kind of get bang for their buck?
Yeah, I mean, certainly the US has historically been a very strong market and has continued to be a pretty strong market. On the flip side, obviously, China has been struggling. Yet the US and China together account for over half of the global spend on advertising, so those kind of things have balanced each other out. I think, obviously, when you look at the kind of different types of advertising, there are digital pure plays, so that's the Googles and the Facebooks of this world. That's been the most resilient in 2022, growing almost 10%, and not surprisingly, there's been more pressure on some of the traditional areas like TV and newspapers and magazines. The TV is an interesting area because it's going through something of a transformation. The traditional 30-second ad slot broadcast over your TV is obviously kind of coming under a lot of pressure, but we're seeing the rise of streaming platforms and this concept of connected TV, and that's actually enjoying really good growth. It's expected to grow maybe 15 to 20% in 2022 and sustain double-digit growth next year too. So that pivot is really important. It's obviously an opportunity for some of the traditional TV companies, but it also opens this big threat. Obviously, we've seen Netflix launch an ad-supported tier for their streaming platform. Disney's done the same in the US. I think more of those streaming-first subscription-based businesses are going to follow that lead and extend it globally, and that's going to put more pressure on the kind of traditional media platforms.
Matthew, you mentioned that digital advertising grew about 10%, and on the surface, that sounds like a good number, but really over the last decade plus, that's been a 20% plus kind of growth story. So we've heard from Facebook's and Google's, that the recession is going to impact their ad spending as well. So talk to us about digital advertising, how you think this might shake out over the next couple of years. What's kind of driving it?
Yes, as you said, this kind of 20-30% growth rate has slowed still, to 10%. It's still outpacing the overall market, which is probably going to grow about 6% in 2022. I think it's going to continue to be a faster growing area of the market for the next 4 or 5 years. But those double-digit growth rates are definitely a thing of the past. I think partly because so many more people now are on social media and all the digital platforms that you just can't keep growing at that pace forever. I think the other issue we've got here is changes to how ads work on digital platforms. So we've had this well-read move by Apple this year to kind of cut back on ad tracking. That's really hurt Facebook. Their revenue's going to be negative. Revenue growth going to be negative in 2022. So it's really hurt them, and I think that's going to continue. And we're seeing more restrictions come from various different regulators. I think in particular in Europe, they're putting tighter controls on privacy and data sharing. So that's making it harder to kind of monitor digital ad effectiveness and to target people the way you used to be able to. So the value to advertisers of digital advertising is definitely under pressure. And so that puts the onus back on the Googles and Facebooks of this world to reimagine their ad products to try to kind of compensate for that pressure.
But isn't Google also under fire for promoting their own stuff? Same kind of thing like with Amazon, for example?
Yeah, absolutely. It's a very complicated world, and I think definitely, that they've kind of perhaps had.
That's like the epitome of frenemies. Like they need each other and they hate each other.
Yeah, completely. And I think that's definitely going to be a challenge for them over the next 2 or 3 years about how they kind of better manage those kind of conflicts of interest, if you like. And it's a great kind of segue into another kind of growing area of the ad environment, which is the retail advertising sector. So lots of the big retailers like the Walmarts are setting up their own retail media platforms. So they're using all of the information that they have about their shoppers and using that to create a platform on their websites and on their apps for advertisers and brands to target their customers. So that's another kind of nuance we're seeing evolve in the kind of ad platforms environment. So that's going to be a challenge for sure to people like Google and Facebook.
All right, Matt, thanks a lot. Tons of stuff. This is just we're touching the iceberg here at this. Bloomberg Intelligence Senior Media, Advertising, and Telecom Analyst Matt Bloxham.
That's this week's edition of Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries.
And remember, you can access Bloomberg Intelligence through BI Go on the terminal. I'm Alex Steele.
And I'm Paul Sweeney. This is Bloomberg.